Good morning, Bitcoiners. Welcome back to another edition of your Bitcoin economic calendar, the news and analysis that you need to know for the week ahead in Bitcoin. Today is Monday, February the 15th, and we have another action-packed week in the markets today. In this issue, we're going to be covering the US trillion-dollar stimulus expectations that are driving markets to new all-time highs. We're also going to talk about how Tesla may have started a corporate Bitcoin trend. And lastly, we're going to go over how to check your proof of reserves on your Ledn.io platform. So lots to cover today. Onwards to our analysis. So before we get started today, we wanted to spend a minute to show Ledn clients how they can check their proof of reserves results on the Ledn.io dashboard. What you see behind me on the screen right now is the dashboard of a Ledn client once you log into the platform. This is a sample profile that I just wanted to use to show you guys where you can essentially check your results for your proof of reserves and the Ledn platform. So in this section here, on your proof of reserves section, you will see that there is a reference number, a hashed ID for every individual user. This is an anonymized ID identificator. You can copy this link here on this button, and then you can head over to the URL link that shows here, which is the Armanino Trust Explorer website, which is what you now have behind my screen. Once you are here, you have the option to check your balance or download the report. When you go here to check your balance, all you need to do is type in that hashed ID that was provided in the Ledn platform. I'm just going to try it one more time so you can see it from the beginning. And here you just paste your hashed user ID that you copied from your balance, and then you click on Find My Balances. And what you will see here is that your balances as of January 31st at 11:59 p.m. Eastern will populate on this form, and you can basically check those balances for your against your balances as at December 31st at 11:59 p.m. So that's just a very quick, as you can see, it's very quick and very simple. And just for your reference, we do expect to do these every 6 months. So keep an eye out for the upcoming proof of reserves attestation, and we will be emailing you guys when that's available as well. Moving on to our price analysis for Bitcoin, we see that we had another neck-breaking week for Bitcoin, closing up 25.24% at $48,680. And it did come within $300 of $50,000 throughout the week, which is very impressive. It's a very meaningful number to start getting close to. And this will likely be referred to in the years to come as the Musk/Tesla rally. We're going to dive deep into the long-term implications in our What's Ahead section today of this Tesla purchase and the continuation, I guess, of the Sailor trend. But before we do that, we wanted to essentially shine some light into some important signals that we also saw in the market throughout the week for Bitcoin. One of them being that Tom Lee from Fundstrat, who is a very, very prominent fund manager, and in my humble opinion, one of the sharpest minds in the game out there, started becoming a little more vocal about his feelings in Bitcoin, saying that Bitcoin is now 1% of liquid assets, and if you don't have a 1% allocation to Bitcoin, you are now indeed short digital assets, which is quite interesting to hear from somebody that with that reputation in the fund managing world. In addition, Mr. Lee then went on to retweet a Meltem Demirors tweet, which you can see behind your screen right now, which tacitly is in a way calling for $250,000 Bitcoiners, saying that this $250,000 price range is within the realm of possibilities, as basically expressed by the tweet. You can check it out yourselves and draw your own conclusions, but thought it was very interesting nonetheless to see him tweet something like that. Lastly, let's basically a quote from Fundstrat's research team, which is also a very important signal. It says, for fundamental reasons, actually, you could see a number of corporate buyers taking positions in crypto more generally. This is a quote from one of the interviews that one of his analysts gave in regards to their Bitcoin comments. Elsewhere, we also saw that BNY Mellon, the oldest bank in the United States, announced its plans to custody Bitcoin. This is a huge signal. It's not a big retail-facing bank, but it's really big in the back end, and the fact that it's the oldest bank in the U.S. is also very meaningful. So it's a big signal for the banking establishment, and could likely cause or potentially cause more dominoes to fall in the same direction. In other news, we also saw that Miami Mayor Francis Suarez basically fully embraced Bitcoin in a statement that he gave to the press, saying that he was pushing an initiative that would allow the city employees to get paid in Bitcoin and for Bitcoin to be accepted as means of payment for Miami city taxes. This paves the way for the city to start holding Bitcoin in its reserves. So again, another very interesting signal from now politicians in cities and not so much corporations. So a last very interesting signal was that we wanted to point out a tweet by Willy Woo, which you have also on the back of your screen. And I just want to open this chart here for a second so you can see. But basically, Willy points out that there's been pretty much an inverse correlation between Bitcoin and gold ever since the Michael Saylor announcement, which is this green dot that you see he highlighted in his photos. So very interesting to see this market dynamic, because as we've pointed out here at length, gold is a much larger market than Bitcoin, and the fact that it may be interested in rotating could be a massive tailwind potentially for Bitcoin. And just as a reminder, gold, even at $1 trillion Bitcoin, gold is still a 10x, a market that is 10 times bigger than Bitcoin. So as we always do, we will be talking about what the options markets and the futures markets are showing for Bitcoin in our What's Ahead section later today. Moving over to the S&P 500, we see that it reached another all-time high on the back of fiscal stimulus expectations. So just to give a more detail on that, President Biden is set to announce a stimulus package that could be up to $1.9 trillion into the U.S. economy. This has sent the markets roaring, with 51% of professional fund managers surveyed are expressing that the package has the risk of doing too much. In other words, professional investors believe that the risk is to overheat the economy rather than the package not doing enough. Just to show you a quick image of this statement, just give me a second. Here it is. So here you see the survey that was run by Deutsche Bank and says, how much stimulus do you think Congress will pass? The majority of the surveyed respondents say it's going to be between 1.3 and 1.6 trillion, with a large amount thinking it'll be between 1.6 and 1.9. The rumors, again, nothing's been confirmed yet, but it's rumored that it could be up to 1.9. And as you can see here on the second image, which is very important, it says, are the risks doing too much or too little? With most respondents squarely on the side of the risk is doing too much. This, of course, is probably a big reason why the markets are basically looking so bullish right now, because of just the sheer volume of new inorganic dollars that are going to be printed into the U.S. economy. So interesting to look at this trend with fund managers now starting to feel like could do too much. You can also start seeing some of this in the 10-year Treasury bill, which is actually at 1.2%. From the 1.1% that we just talked about a few weeks ago. So something to keep in mind. We'll talk about this a little more in our What's Ahead section later today. Moving over to gold, we see that the renewed expectation for this $1 trillion stimulus package out of the U.S. government was enough to push the dollar index lower and gold higher for the week. As we can see here, gold closed last week up 0.56% at $1,823 per ounce. And if we compare that to the move in the dollar, we see that the dollar was actually down 0.68% for the week. Although subtle, it is interesting, and we do see that gold seems to be lagging on the way up and accelerating on the way down. This trend may continue as investors look to shield their portfolios and protect themselves from the new cash injection. Another interesting thing to look at here is that commodities like even oil, look at oil, how it's rallied. It was up 4.67% last week, and even copper. Like look at copper was up 5.18% last week. So we're starting to see a lot more outperformance from other types of assets. Basically, not precious metals, but commodity metals are outpacing gold. Interesting to see this, because we're not the only ones that are basically starting to ring this alarm. Here in the back of your screen, you see an article from Barron's that says gold is way down, when to worry. This may start a trend, because more people are basically starting to take notice that gold seems to be in a way, underperforming on a relative basis, which some can interpret as potentially falling out of favor in portfolios. So that can have very meaningful implications. And I wouldn't be surprised if we started seeing some more headlines around that theme in the coming weeks. So something to keep an eye out in gold. If gold continues to deflate, it could be a tailwind for other types of markets. Moving over to the DeFi index, we saw yet another monster week for the FTX DeFi index, up 15.28% on a week of strong volume. Ethereum was also, it's just going to pop up Ethereum here. Ethereum last week was also up 11.66% at 1,804. And both of these sectors, I guess DeFi is very much affected by any potential narrative around Ethereum. And with the narrative around Ethereum being positive last week, given the CME futures launch, as we had discussed, this seemed to be, or this could have acted as a tailwind potentially for both DeFi and Ethereum. And as we've discussed here in the past, the main risk that could have potentially faced DeFi, which was regulatory action by the US Treasury, that regulation was blocked by the Biden administration. And that seems to have re-sparked the fire of investors and founders alike. And while there continue to be flash loans and liquidity drains like this recent $37.5 million exploit that you have behind your screen of the Cream protocol, investors seem to be willing to take the risk, as you can see by the price action in the DeFi index and Ethereum. So going back to the chart, and I guess as a closing comment, the institutional validation of the Ethereum futures is likely playing a factor in this ecosystem that is built on top of Ethereum, and it can continue to flourish basically on this backdrop of this positive narrative. This trend shows no signs of stopping anytime soon. However, signs of excess in the market continue to abound, as exemplified by just a few examples. So XRP is basically trading at levels pre-enforcement action by essentially all US authorities. And the other one that we see as a sign of excess is, again, Dogecoin, up over 400% in the last 2 weeks. So just a note to say that these markets move really fast, and be careful out there, friends. Moving over to our Bitcoin mining difficulty commentary, we see that hash rate has continued to pour into the network after the next difficulty adjustment, and the upcoming adjustment is set to take us to a new all-time high of approximately 22.32 terahashes from the current 21.34 terahashes. The surge in hashing power has been quite significant, and the next adjustment is likely to kick in ahead of schedule this coming Friday evening. Now, while the blocks are being produced in intervals that are slightly under 10 minutes, the mempool size is still at very high levels. So just for reference, I want to show you guys where the mempool size is right now. Currently, we're about 69.7 million bytes, and that's still very, very close to the all-time highs. It sounds like it's still far away, with the all-time high peaks being 136 million, but normally we consider 34 million bytes, a lot of activity in the network, or a bloated mempool. At 70, we are basically double what is standard congestion for the network. So all this to say that transacting in Bitcoin, in the Bitcoin network, and having those transactions be confirmed fast will be expensive. And the transactions that are not paying up very large amounts will likely take slightly longer than normal to confirm. So this is just a note, essentially, so that you can be aware of this and plan your transactions accordingly. So as always, we leave you with what's ahead for the week. Back in September 2020, Michael Saylor announced his first corporate purchase from MicroStrategies and said that it would take a similar company between 6 and 12 months to complete a similar purchase. We noted that, and basically noted that we could start hearing about corporate allocations 6 months after Saylor's purchase. Tesla took 5 months. Tesla's announcement will likely not be the last one we're going to hear about in the next month or two, but it is also likely to kickstart a wave of Saylor-style conversations around corporate treasury boards. And similar to the Saylor effect, we could potentially expect a new wave of future corporate announcements around midsummer 2021, which is about 6 months' time from the Tesla purchase announcement. So something to keep an eye on. Elsewhere, the new potential $1.9 trillion package out of the US from the Biden administration will certainly have investors' minds shifting back to the melting purchasing power of their cash balances. This could potentially keep driving most US denominated markets higher and keep creating GameStop and Doge-like dislocations due to the pent-up demand in portfolio returns across retail investors, as well as institutions. Retailers aren't the only ones facing this problem. In fact, I would say institutions likely have a bigger problem because of the size of their cash balances. So parallel to this, we're also seeing gold underperform most asset classes on a relative and absolute basis. This cannot be understated as, again, just to recap, gold is an $11 trillion market, which is showing continued signs of people potentially wanting to rotate out of it. So another very important thing to keep in mind. Now, on the Bitcoin futures front, we do continue to see a healthy contango on the curve, with the June futures topping up at $50,885. And on the options front, we see that in the February 29 expiration, so the February 29th contract, there's strong open interest around the 48,000 level and at the $60,000 level. It's worth pointing out that volatility on these near and far dated Bitcoin options contracts is trading well north of 100%. And to put things in perspective, the implied volatility on an S&P 500 contract is about 17%. So something to keep an eye on. Lastly, the funding rates on the perpetual swaps for Bitcoin and Ethereum are well below their 30-day moving averages. This means that investors in these assets are not or do not seem to be too over leveraged, which is typically a healthy sign for the markets. So as always, we'll continue to keep you updated with any relevant information throughout our social media accounts and right here at the Bitcoin Economic Calendar. If you learned something today or if you enjoyed it, I welcome you to subscribe, like it, and share it with your friends. And if you don't yet have a Ledn account, I welcome you to check out ledn.io to learn how you can start earning 6.1% on your Bitcoin and 12.25% on your USDC. Thanks, everybody. Have a great week and see you next time.